Hi trader, this is Chris from Elite Currency with another video on the Fibonacci series part 10. We're going to take a look at the structure and candles of the market and how we can use Fibonacci with that. First of all though, be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This video is for educational and informational purposes only. If by continuing watching this webinar or video, you agree with this disclaimer and you're aware of the risks. The Forex market encounters many ups and downs on all levels, from the very lowest to the very highest time frames. And these retracements basically occur on various scales. First of all, we have trends, then we have swings, and then of course the smallest level or unit is the candle. So basically what we see here is an example of a fib on the candle, where you can see a retracement back to the 38.2 fib and the 61.8 for instance. That's a simple way of placing the fib on the candle. But there are also other fibs, like for instance fibbing a trend or the swing. And that's something we actually talked about the last 3 weeks when we discussed, for instance, fractals, the AO, and fibbing when hitting the target. Those are actually techniques for placing the fib on swings. So what is the difference? Well, basically, those black lines are a channel. And when a channel like that gets corrected, we can put the fib on the entire channel. We have also minor channels. This is something we'll discuss next week. Then, of course, we have swings. Within those channels, you have ups and downs. Those are swings. And the last 3 webinars or videos, we talked about that. Today's video, we're going to talk about the smallest unit. Because within a swing, we have candles. Right? And each candle gets retraced as well. So we have a retracement of the trend, we have a retracement of the swing, right? And then we have the retracement of the candle themselves. The market's nature is to retrace almost each and every part of the chart, with of course the occasional exception during moments of strong momentum. Grab a chart and analyze it closely, and you'll probably notice that most candles are at least partially retraced. Probably up to 95% of them, if not more sometimes. From that point of view, it makes sense to wait for a retracement first before entering. And that's why we have the following slogan. An easy way of remembering that is, let it center before you enter. That's a simple slogan to avoid common mistakes like taking the trade too soon or too late. Alright, so we want to have the patience for the retracement to occur before entering. So therefore, let it center before you enter. So let's grab one of those charts and see if that's true. If we look at this piece of chart, you can see quickly that not many parts of this chart are indeed not retraced. We can see, for instance, that this candle got retraced right in here. And all of these candles to the downside here all got neatly retraced. To the upside as well. Alright, all got retraced. One of the few exceptions of a candle that never ever got retraced, or at least on this chart, was this one problem, this space. I don't think that price went back far enough. What I consider a retracement is the 38.2 fib. So what I do is I put a fib from candle low to candle high in a bullish momentum, or from candle high to candle low in a bearish momentum, and I have the Fibonacci retracement levels of that candle. What I'm looking for is a minimum of 38.2, otherwise I don't consider it retraced. If the candle is exceptionally strong, with a bigger size than usual, then sometimes indeed 23.6 fib is used. Alright, so in this case, in example number 2, you can see the price had a good candle, but it was not exceptionally big. Price moved down to the 61.8, got retraced, didn't break the low, and moved higher. Alright, that's a typical example of a candle that got retraced. So obviously, this is a great technique for an entry, getting a bit of a discount. Now, the stop loss does not necessarily have to be above the high or the low. It could be, but I only do it if I use a high enough time frame, like the 4-hour, like the daily, or the weekly. Alright, so I wouldn't be using that technique of a stop loss below the high or low on a lower time frame like the 5-minute chart. The Entry, of course, is clear, and obviously this is a great technique of getting a pullback. Now, it's simple. It capitalizes on the natural highs and lows and the tides of the market. But of course, there is the necessity to make a proper analysis before taking the entry. Just, this technique alone is not enough. It has to be a solid trend analysis to make sure that the fibbing of the candle makes sense. There must be a reason why to do it. I wouldn't just start fibbing every and each candle. My analysis has to say that I'm interested in taking a long or short at that spot, and then this is a way of catching a bit of a discount. Alright, please make sure to join us with the 14 free webinars we will have in August and September. Join the list here and sign up for those webinars by writing to info@elitecurrency.com. Hope to see your email and wish you all good trading and happy hunting. Cheers!